All right. Well, welcome back to the show, everybody. You are listening to the QY Growth Podcast, Ask Why Podcast. I'm your host, Kyle. Thank you for being here. If you have a business opportunity for multiples to make money, shoot me an email. My email is contact@qygrowth.com. That's contact@qygrowth.com. Or go to the website QI Growth and fill up the form. If you're looking for more shows on a weekly basis, we've got you covered. Um, all right, today we have an awesome show. Listen, Daniel, thanks for being here. We um, we are joined by Daniel on this occasion. Daniel Noe, everybody, and this is it's very interesting how everything came together because I was recently in a podcast with the agency in the travel niche, and they offer 40-50% discounts in any type of trip. I like Cancun. I especially like Cancun. Uh, Being in Mexico, it's a beautiful sand. It's so great. Best hotels, 50-40% discounts. If you want to hear more about it, we had that episode. It was great. And using credit cards for air miles to fly almost free, amongst other perks, um, bonds perfectly well with what we have right now in credit card strategies and the right ones. To be honest, you need coaching on that side. If you don't, we try to give you the best information here, but there's nothing better than taken by the hand and shown how to use credit cards for air miles, um, and other things like I say. So with that said, what we will do is an overtime show where we're going to go half part of the show and we're going to focus a little bit on your upbringing, your history from childhood up to the adult life, where you started to steer the ship, and full context as possible. Feel free. There's no handcuffs on time. Uh, if you want to share as we migrate into your business funding experience, just feel free to do that. Millions in funding, and there's a lot of excitement behind it. So welcome to the show.
Thanks for having me. Really happy to be here.
It's great to have you. Let me ask you this question really quick. What type of family do you come from?
I come from a huge family. I my mom is from Italy. Um, my dad is from here, from the Boston area, United States. And yeah, it's a interesting, story, not to get all into it, but he was basically US military back in the 80s. He was based in northern Italy. Somehow met my mom. Within 6 months they got married and he brought her back. And so he came home with an Italian wife, and um, the rest is history. I mean, they had a kind of a crazy life when they were younger, early marriage, and then they kind of found God, found Christianity, and decided to be open to life. And um, whereas before, they weren't really planning on having any kids, then they ended up having 11 kids. So I'm the oldest of those 11 kids, and super grateful for them and for that experience. Yeah.
The main reason of that question is, there's a lot of people that might come from situations where they think that they're not that there's it's very popular, the saying set up for failure. um you come from a migrant background, which is amazing, and being able to tap into this. Well, what was your mindset in your upbringing?
Oh boy. Um, well, I kind of, neither of my parents had gone to university. You know, um, Pretty working class. I mean, my parents also, we spent a lot of time traveling around when I was younger, working for the church and kind of missionaries, doing kind of missionary activities and stuff. And so that was a big part of my younger life, and moving around a lot, changing schools a lot, having, a lot of different experiences. Um, But on the other hand, when it came to like education and business and stuff, that wasn't really a priority. I mean, for sure, my parents made me go to school. They always put us in the best schools they could. A lot of times that was Catholic school. Um, and they, uh, put an emphasis on us going to university, going to college. Because they hadn't, my mom has since gotten degrees, in her, older years, but as a kid, she didn't have at the time, she didn't have college degrees or whatever. So, um, while they were very intelligent people, they weren't, college educated. And so they really pushed that on us. And, I did the whole traditional route, went to college, um, got a business degree, and started working in corporate America, doing mostly in the tech space. In the Boston area here, we have a very thriving tech sector, a lot of software companies. And so I managed to get into sort of sales and then enterprise sales, and then into the post-sales side, sort of doing customer success, account management. And, then I started learning all this stuff about marketing, and started up my own business, which was a custom woodworking business, with a good friend of mine. And here in the Boston area, we scaled that to almost $1 million in revenue. It was going really great for about 5 years, 6 years, and then economy slowed down. I think luxury items have taken a little bit of a hit in the last few years, so that allowed me to sort of expand into giving me time to work on getting into other types of businesses. So I've dipped my toe in marketing. I've dipped my toe now in funding. But the funding thing is very interesting because it's actually only because I was a business owner that I even learned anything about this. The only reason I know anything about 0%, credit stacking, business funding is because of my experience doing the custom woodworking business.
So I believe that that experience brought you to a place where, I mean, from childhood, maybe you wanted to do something similar to that. You wanted to be there, and it allowed you to get the funding that you needed for that business to take off, right? Is that
Yeah, it was a huge part of our success. I mean, we were able to invest in materials, to invest in ads. Once we saw that we had something that was working, we're like, we gotta scale this so that we can make a living off of it, as quickly as possible. And so being able to take that 0% money and invest it in buying wood and materials and machinery, having it on hand for cash flow issues, and being able to scale on ads, all that kind of stuff really is what helped us take off and get it to the point where we did. Otherwise I think it would have taken a lot longer. Generally speaking, the sort of more organic methods can go pretty slow, especially when you're a local business. So the 0% funding came in very useful there. Yeah.
Yeah, last time you talked about it, it was 0% in the concept of credit cards with interest, 0% on interest funding. Could you walk us through the balance transfer process in more detail, like how how entrepreneurs manage multiple cards, and then the prompts on the periods, and if the 0% is maintained, and how does that go?
Sure. Yeah. So we're talking about 0% interest business funding, which means uh, applying for multiple credit card lines at promotional rates where many of our customers are securing anywhere from $50 to $150,000 in business funding through this method on various credit lines at 0% interest, which means they don't pay any APR for usually 12 months, could be 6 months on some cards, could be 18 months on other cards, or 15 months. Generally speaking, the average is around 12 months, right? And a lot of people, and we'll get into it, but this is used for all different types of businesses and for all different reasons, this type of business funding. But one of the best ways to use it is to offload other balances that you have. So let's say you've been using a credit card that didn't have a 0% interest rate for whatever introductory period, and maybe you've been carrying that debt for a while in your business or what have you, you can do something called a balance transfer, right? And what you do is you apply for a new credit card with that 0% APR introductory offer. You want to make sure that they offer that specifically on balance transfers, right? And they can range typically from, like I said, from 6 to 18 months. 12 months is pretty common. So you initiate the balance transfer by providing the new card issuer, right? The bank that gave you the card, with the info. You give them the info of the credit card from which you want to transfer the balance. And that kind of happens automatically behind the scenes. They will take the balance from that card, put it onto the new card at 0% interest. There's often a balance transfer fee. It's usually somewhere from 3 to 5%. Once in a while, you'll find cards that waive that or don't have a fee, but usually it's about 3 to 5% to transfer the balance, and which is a one-time fee. And so you move the balance to the new card, and in doing so, you pay off the old card. And now you're paying, the balance on this new card, but at 0% interest rate rather than, 15, 20, 25%. And another reason this is really important is because once you start doing this credit card stacking method, if you decide to work with us, you're going to take, let's say you get $50,000 in 0% interest, and you take $20,000 of that and you put it into ads, right, for your marketing. Well, you're going to get a return on investment, obviously, and ideally you would pay off that $20,000 within the 12-month introductory period, right, where you have the 0% interest. But it may happen that you get to the end of those 12 months and you still owe $5,000 or what have you, right? So what you would then do is what I just explained, is initiate a balance transfer. You apply for a new round of funding. You get a few new 0% interest credit cards, and you transfer the balances from the old cards to the new cards to keep that 0% interest rate going. So you got to make sure that you do it before that introductory period expires, because once it expires after 12 months or 18 months or whatever, you're going to be paying, the normal credit card interest, which, like I said, could be 18%, 25%, which really hurts, right? So you got to keep track of your cards, when you applied for them, when the promotional time period expires. I usually just put everything in a spreadsheet, all the cards, their numbers, which bank I got it from, the date it was approved for, the date the introductory period expires. I keep track of the balances, how much I took out on this card or on that card. It's very simple to just throw it together in a spreadsheet. But that's basically, the balance transfer process.
And that, I think, is where some call liquidation strategies or being able to cash out most common mistakes in credit card stacking. And I believe that like that, there's a plethora of them. Many entrepreneurs might be excited to try credit card stacking after hearing about the benefits. What are some of the most common mistakes or pitfalls, let's call it that, you've seen people make when implementing this strategy?
Okay, so some of the pitfalls, mistakes so I would say the number one thing that I think, unfortunately, the number one thing that I see kind of disappoint most folks who get into trying to do this, especially if they try to do it on their own without professional help or without a strategy, right, is that they overestimate their approval odds, right? They think they're going to go out there and get 150K on a one-year-old business with a, 690 credit score and a late payment, within the last 6 months. I mean, not having ideal credit, having a business that maybe isn't, where you don't have any sort of proof of income, which you don't necessarily need, but it helps if you do have a high, proof of high income on a existing business. And you think you're going to get all this money, and then you don't. And they go out and do it themselves, and they get 10K. I mean, it happens all the time. They think, I can do this on my own. Maybe they found a course somewhere, or watched a few YouTube videos, and they think, I'm going to get all this money, and then they go out and, if you don't have the relationships with the banks, you don't know all the little details and the rules of how to apply and when to apply and which banks, have limits on how many cards you can apply for in a certain amount of time. There's all kinds of different things that you have to be an expert to know, because you have to be in the world of funding. And so we have funding coaches that, that's what their specialty is. They keep track of all this kind of stuff, all the new cards that are coming out, and which ones are still 0% interest, and for how long, and all of that, right? So that's one of the main things I see is people overestimate what they think they can get. And then, they get rejected by a bunch of the cards, and then they have all these hard inquiries on their credit, and then it's hard to do another round of funding. You know what I mean? So then they got to wait 6 months. So that's one of the big things. I think another thing is not paying attention to that promotional period, and, getting 50K or whatever, using all of it, taking out all that money, investing it in your business. And then all of a sudden 12 months goes by and you're like, shoot, I still have 30K to pay back, and it's literally expiring in a week, and I got to do another round of funding. And it becomes very stressful because, you're going to get another 30K to be able to transfer those balances if you're rushing things, you know what I mean? Because you want to do things right. Another thing is just mismanaging in general, credit utilization. There are some cards that you can carry balances on, some business credit cards that you can carry balances on and not get penalized on your credit score. But there are some that it's not the case, and you're carrying $10,000 on a certain card, and it's actually reflecting on your personal credit. So you got another big thing, that pitfall is, just mismanaging that credit utilization. And then the general thing is, I think goes without saying kind of, but just not planning on how you're going to repay the cards. I mean, it might be mind blowing for some of you to hear this, but some people are like just starting out their business. They maybe don't have a proven track record or plan in place. And, they take out 50K or whatever, even 20K, whatever it is, and they start testing it on ads. They buy a little bit of inventory. They hire somebody that, whatever it might be. And all of a sudden, they just spent 20K. It may be 0% interest, but they haven't generated a return on investment. And it's like, how am I going to pay this back? Right. So those are kind of like, generally speaking, the main things. There are other little things like missing payments and stuff but that's generally people who work with us are very conscious of their credit score and keeping that clean, and they don't make little mistakes like that. But those are kind of some of the bigger ones, I would say.
I think that the whole nightmare of letting the APR run if you're lucky, 18 months, right? Usually it's a year. The nightmare of letting that run until the end of it, uh, that's just having no awareness of the strategical depth that you're going into. So it's really good that you mentioned that. There's real estate investment cases, real estate investment, which is very popular, that people get loans to get credit for flipping. I've been in the sales and marketing game for real estate agents, building up their list of people that are selling, people that are buying. That's how at the long run you make a lot of sustainability money with into thousands of numbers. You mentioned that credit card stacking can be uh, particularly used in real estate investments. Can you share a specific case study or an example of how an investment or investor successfully did that for their business?
Yeah, actually, I was just working with a guy, Alex. I think I just talked to him within a week or two ago, who's, he's relatively new to real estate investing. He's already had a career doing other stuff. He was actually also in tech. And he decided to get into real estate investing on the side. And he had a pretty, I guess you could say, distressed property. It was a good deal though. So he came across a single family home, but in need of pretty significant repair. He was going to get into it at a really good price. It was like 150K or something, well below market value for that area. I believe it was in the Carolinas. And I think he had an estimated renovation cost of like 30 to 40K. And, potentially he said he would make about 40K after all of his costs and whatever. If he then put it back on the market and sold it for what he was hoping, or for market value, he should have made about 40K in profit after it was all said and done. Right. And so, we had gotten him, he had already gotten the credit with us. We done his funding prep, got his business all set up right. We'd gone through his personal credit with a fine-tooth comb, made sure he was, sort of optimized. He didn't have a ton of credit history, which was, kind of limited him a little bit because he's on the younger side, but he was able to get 50K, roughly. It was like 48K, something like that, in 0% funding. And he it was over like 3 or 4 cards, if I remember correctly, all at 0%, and mostly for in the 12 to 15 month range. And so he was able to basically take 35K of that from these credit lines that we got him, and be able to cover the down payment, the closing costs, and sort of the initial renovations. And it kind of all worked out. He had a local contractor, was helping him, and it kind of worked with him on, giving him time to pay and gave him some flexibility and what have you. And yeah, when it was all said and done, he managed to pay off the card, sell the house, just about market value, maybe a little bit under what he was expecting, but still good. And yeah, he ended up making, I think in the end, just under 40,000 in profit, right? So the 0% interest cards really came in handy for sort of just being able to put balances, on these cards while this process was happening. I think, from one end to the other, it was probably like 7-8 months that it took him to do all this. And so he had plenty of time to work within that 0% promotional period and sort of get the deal done. So yeah, he had a great ROI and a great overall experience. And, we managed to keep his credit score healthy throughout. And so he can go out and do another run of funding and flip another house, make another 40K or who knows, maybe more. Because obviously, in real estate, the more you do, the better you get at it. It's like baseball. The more at bats you get, the easier it gets to be able to fix and flip and find deals and do marketing and all that stuff, right? And so he's still early days, but he's already doing really well. So
That's great.
yeah, in large part thanks to being able to get this 0% funding.
Mm-hmm. 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 Yeah, when we go into things like real estate, uh, it's a very personal vision, right? It might be accurate that it's going into the bigger corporate side, creating a lot of Airbnbs, and it's kind of being taught to do that, and then you can sell your business with the asset, and that it'll tokenize eventually, and things through, Ether or Ethereum, in that type of blockchain, minting situations, specifically contracts, there's 0% usage in speculative investments. So some listeners might be considering using 0% business credit for more speculative investments like cryptocurrency or Forex. Um, I know there's a lot of risks or ethical considerations when you get this type of credit, because you should already have something producing revenues before jumping into strategic debt, because it's like you want to be able to add gasoline to the fire, not try to kindle the fire with it, because you step into the pitfall or the nightmare. So what's your thought on this approach?
So specifically, using it in like speculative investments like crypto and Forex and stuff like that.
Yes.
Yeah. So it's one of those things where you can do it, and we work with a lot of people who do it. I would say, real estate's obviously always kind of in the top one of the top categories of the customers we work with, but not far behind that lately. I would say there's a lot of folks in Forex, some in crypto, a lot of day traders, a lot of folks in the sort of, you get into these groups where they have trading bots, and they're using 0% business credit to be able to fund their trading accounts, right? Now, if you know what you're doing, the potential is incredible, right? I mean, because it's obviously the more capital you can bring to bear in your trading, the more potential profit, right? If you know what you're doing, right? However, as a word of caution, I would just say that, obviously, if you do trading, you know that these markets can be pretty volatile, right? You know that it can be pretty unpredictable.
It's
Um,
speculative.
it's exactly why it's called speculative. Yeah, exactly. And you have that 0% in promotional period with the 0% credit, maybe 12 to 18 months, and if you have a sudden downturn in the market, um, at the wrong moment, you could be left with significant amount of debt and maybe not getting the returns you need to be able to pay it back, right? So prices can swing dramatically in a short period, and if you don't really have a good system, making sure that uh, minimize your losses and maximize your gains, it can be pretty tricky. Now, on the other hand, I've worked, like I said, several guys in day trading, forex trading, bot trading, who are, from what I hear, are crushing it. I've never done it myself. Um, is it legal? For sure. I mean, it's business credit, and you're using it to fund your business operations. Um, I probably wouldn't open an LLC and tell the bank when I create the bank account, yeah, I'm going to be using this, these funds for for trading. They'll probably shut you down, or not want to work with you, or may not give you nearly the amount of credit you think you would normally get. Um, that's why we usually tell clients when they create their business entity, make it something boring and very conservative and something that the bank would like.
They
Um,
hustle you. You go to a car lot, they're going to sell you their best, not your best.
exactly. Um, so yeah, it's just something you got to be careful with, right? Because there's a potential for accumulating debt and then not being able to pay it back. But that goes with any business. You can also, we work with course creators, coaches, consultants, and you can easily blow through tens of thousands of dollars in ads in a month. And if that was on a credit card and you didn't sell anything, if you didn't make any return on that investment, well, you're going to be in a heap of trouble, right? So it really can go for anything. You could even a woodworking business like I used to have. If I didn't know what I was doing, I went out and bought a bunch of, I don't know, a bunch of mahogany, which I think I can count on one hand in the 7 years we made hundreds and hundreds of tables out of beautiful hardwoods, walnut, oak, all that good stuff. I can count on one hand the amount of times we made a table out of mahogany, that sort of reddish, dark redwood. And if I just, at the beginning thought, I know people like mahogany, which they do for other types of furniture, not for tables, for other types of furniture. But if I got on and just bought a bunch of mahogany, I'd be like sitting on all this mahogany and not selling any tables, and people, and just be left with all this debt and no return, right? So, and the same, so that goes with everything. And I would, in a special way, include speculative investments like crypto, forex, day trading, stock trading, bot trading, all that stuff. While we have people doing it and it works for them because they're pros and they're veterans of the space and they know what they're doing, you also got to be very careful because at the end of the day, you're still borrowing the bank's money.
That's true. You're using other people's money to make money, not to spend it. So,
Mm-hmm.
uh, adding to that crypto side, if you're able to buy a spot, for those apasionados of crypto and leveraging uh, 10x, 25x, 50x is out there. I'm one of those. With $100, 50x, and sometimes it's a casino. So you don't really you can't estimate the influx of the market, how much of it is being sold or bought. You could just look at the wave estimated, and according the longest tooth wins, right? Especially the FANG. If you have expertise behind it, if you're in leverage credit, even so, let's put it like this: spot buying a spot, very different from leveraging ups and downs in the market. You buy a spot, let's say you buy XRP at 37, like I did, and then it goes up to 60, then you grab it back, you liquidate it, you make it cash. You don't let it go back to 40 because it's waves. And when up to $1, you get it out at 96 cents of a dollar. And then you buy a spot in the lowest where you know it's not going to go to zero because it has a fintech and so utility in the financial field. No, but it's not going to die. It's not like Pepe coin. Um, but yeah, then that ideal candidate, right? What qualifications as somebody that wants credit must have, and what you emphasize the most important of good personal credit for qualifying uh business card stacking, um emphasizing back into that, saying, okay, well, you know what, uh, tax report, maybe you don't look into that. And I know some businesses, they don't need to show any type of tax documentation. There's no proof of income and some needed. Like you mentioned before, having the relationships and being qualified to leverage them in a personal note. Can you be more specific about what we look for in an ideal candidate?
Yeah, so after working with hundreds of customers, and I have funding coaches on my team who've, before they worked with me, have been in the business for 15, 20 years and have literally coached thousands of people, in all different types of funding, but specifically in this 0% credit stacking. Um, After having all this experience, we've kind of figured out who's going to get results and who isn't, right? So generally speaking, there's like different tiers, right? The top tier is if your credit score is in the 720 plus range, 720 up to 850, which is I think the max. Um, they're usually the ones who get multiple cards with high limits, right? And it's much easier for them to do so. If you have good credit, in that 680 to 720 range, it will still work, but your total available credit is going to be lower. You're going to probably get fewer of those top tier 0% APR offers. And you'll probably get rejected on a few cards, more than you otherwise would at a higher credit score. If your credit's below 680, it's you're gonna get, if anything, very, very low balances, right? So in general, you want to be above 680, but ideally you want to be above 720 on the credit score. You want to have a decent amount of, in terms of credit history, you want to have a long length of credit history, at least 5 to 10 years is sort of the most advantageous, if you can be in that range. So shorter credit history is going to limit your options, You want to have pretty low credit utilization ratio. Definitely below 30%, but optimally below 10% is the gold standard. So, for example, if you have, just to keep it simple, $10,000 across all your personal credit cards, and you've used $3,000 of that 10,000, that means your utilization rate percentage is 30%, right? 3,000 is 30% of 10,000. So you want to
That's
be at
key.
1,000 or less, right?
That's
The
key.
lower your utilization, the better.
When I was working as a sales agent, and I'm so glad that you mentioned it because there's people that jump in expecting that their credit utilization is great, right? They've used
Mm-hmm.
5K of 20 available.
Mm-hmm.
It's what you said. It's really difficult. The golden area is 10%, maybe 15, right?
Yep. Yep.
But more than that, it's just like you've used more than the account should be used for it to not raise a little bit of a flag. Is that right?
Exactly. Yep. You nailed it. I mean, it's 10 to 15%. You really, you can have as much as 30 and still get something if you have a really good credit score, but you really don't want to be up there. Um, and a lot of people think they have great credit utilization, like you said, thinking, no, I have 20K worth of credit on the personal side. I have access to 20K limits, but I don't, but I'm using 6,000 of that. Well, man, that's like 25% right there. So, so that's one thing. A low debt to income ratio is essential. You want to be below 35%, ideally. So that this is the ratio that compares your monthly debt payments to your income. So that kind of helps lenders assess your ability to manage, and taking on any more debt, right? So you want to have low debt to income. You want to have a spotless payment history, no late payments over the last 24 months, ideally. Even one missed payment or late payment, it's crazy. It can really negatively impact your credit score.
What
Now,
happens
if you do, I'm sorry.
for example, if I'm making 10K a month, right, which is the first challenge that we have. If I'm making 10K a month, what would be the ideal scenario of me spending what I'm able to spend for me to eventually get more credit?
So,
10%,
uh,
right? Maybe 15% of it.
yeah, exactly. You're talking about credit utilization,
Credit
or
utilization applied into the techniques that you were speaking of.
yeah, yeah. I mean, like, yeah, you don't want to use. So if you only have $10,000, you don't really want to use you don't want to really be carrying a balance of more than 1,000, generally speaking, right? Because you want to keep it 10% or less. Um, the thing with credit is, like, you want to show the banks that you have access to credit and that you actively use it, but not that you use too much of it and carry high balances, right? That's kind of the trait, like the balancing act that you got to play, right?
Right. And for
So,
example, if I'm making 10K normally per month, and then I think it can balance out the amount of money I'm making per month, so I can cover that for the bank's security in a way, saying, hey, you know
mhm,
what, I have access from my business. And going back to, in some situations, we're required proof of income. In others, well, maybe proof of income shouldn't be that much of a case, right? This case, if I don't, yeah, it balances out to put in a short way.
yeah, yeah. If you have, yeah, and so if your debt to income ratio, like we were saying, is also essential, right? And you want to make sure that, if you're making $10,000, but your monthly spend is $8,000, well, man, your debt to income ratio is sky high, and they're not going to want to
Exactly.
give you any more money or let you take out any more debt, right? So that's that. So we said credit score, credit utilization, debt to income ratio. The other thing is payment history. No late payments or missed payments over the last 24 months. Now, if you miss a payment or you're late on a payment, what you should do is immediately call the lender and try. They'll often work with you and will not, like, put that on your credit score if you call them soon enough. If it was a mistake, right? Like, you switched your bank account and for whatever it didn't work, and then they tried to take a payment on auto pay and it didn't come out. Now you're 2 days late or 8 days late or whatever. You want to call them as soon as possible and make sure that doesn't end up on your credit score. And then the other things to keep in mind are, how many hard inquiries do you have on your recent history, like in the last 6 months? You don't want to have more than 2 to 3 hard inquiries in the last 6 months. Because in each hard inquiry does, typically in a minor way reduce your credit score, but they just don't want to, too many hard inquiries in a short period is a big red flag for lenders. And then the other thing I would say, the ideal candidate also has a diverse mix of credit, so not just personal credit cards. They want to see that you also have maybe auto loans, mortgages, other types of, personal loans, business loans, whatever. They just want to see that you can responsibly manage different types of credit. So you don't want to just have credit cards, and you want to have a kind of a mix. So those are sort of the big, things that come to mind when I think of the ideal candidate. So just to recap, right? Ideal candidate has great credit history, low credit utilization, low debt to income ratio, a stellar payment history, few hard inquiries in the last 6 months, and a good mix of credit, not just credit cards, but auto loans, mortgages, etc. And if you have an existing business and you're crushing it in that business, having strong business financials can really boost your chances of getting high limits and just more credit in general. A lot of people come to us without that, and it's fine. Just with your personal credit and zero proof of income, we can get you pretty good amounts of credit, 0% credit. But if you do have a thriving business and proof of income in the business and strong financial statements, we can get you a lot more. So that's kind of the overall picture. Obviously, No bankruptcies, collections, major derogatories, that stuff kind of just completely disqualifies you.
Very well said. With it also comes accompanied uh, things like, are there any legal or ethical considerations to be aware of whenever I want to liquidate my cars? Or could you elaborate more on the process? I know there's a fee involved, and how does that compare to other methods of accessing cash or getting credit cards like these?
Yeah, so there's a couple different ways of liquidating cash. So, cards often come with like some level of cash advance option. I personally wouldn't use that just because you're going to get killed on interest and it's also limited anyway. Like you can only take out a certain amount in cash, right? Um, so what folks who work with us typically do is they find so there are some guys I know who have set up business owners who've set up their own merchant credit card accounts and will just basically charge their own accounts and then the cash goes into their bank account, um, and then they're able to take that. So what we say when we say liquidate a credit card, we mean basically strip it and take it and turn it into cash, right? There's usually going to be some kind of fee involved with doing that. So, like for example, even if you run it through your own business's credit card processor, you can run $10,000 and that money will go right into your bank account. However, there is a processing fee of the merchant account, which is usually 2 to 4%, somewhere in that range, and they can get pretty suspicious of that kind of activity, so you got to be careful, especially if you don't often run large amounts through your credit card processor. They might flag stuff for fraudulent activity. The other thing about that is then you don't get a corresponding invoice to be able to write that off as a purchase on your taxes, right? Because you want to be able to say, yeah, I swiped this card for $20,000, and you want to get an invoice back for that, saying that you can use in your when you file your taxes. Now, other people, most of the folks we work with, instead of doing what I just explained with their own merchant account, will find a business that basically will do this for them, do a credit card liquidation, which means somebody you got to trust, you want to develop a relationship with, or you want to know that other people are using them and have had success. But essentially, same idea. They'll send you an invoice for $20,000 for consulting or whatever. You'll pay it. They'll wire you back the cash to your bank account, but minus the fees, right? So minus the merchant fee, which is like 2-3%, and then minus a fee for them because they got to get a cut. So another couple points on that. So you might be out 5%, 6% on going that way, but you do get that corresponding invoice to be able to write that purchase off on your taxes. So that's a way to liquidate. Now, it's technically legal, right? I mean, at the end of the day, it's just somebody swiping a credit card on a payment processor, and it happens all day, every day, from very low amounts to very high amounts, and it's technically legal. Obviously, if like I said, if the bank sees that all of a sudden your business on a day-to-day basis takes payments that are in the $100 range, $200 range, all of a sudden you're swiping in 3 days, you swipe $50,000 worth of credit cards. There's going to be like a fraud, consideration there on the merchant and the bank, and you might get shut down. So you just want to be careful about just misusing the credit, acting ethically, as much as possible, while still being able to do what you have to do for your business and being able to cash out on those cards if you need it to be turned into cash, which you may not necessarily do. Often that's the case though in like real estate. You want to be able to liquidate the card, turn it into cash. So there are ways to do it, and they're technically legal. You're going to lose a few points, but you can do it, and you just want to be responsible and make sure you have a repayment plan.
Right. There are creative ways of using 0% business funding. We've discussed many of them, and operating expenses. What are some more creative or unexpected ways your clients have leverages have leveraged this funding? Is it something that you constantly seen, or what are the best cases?
All right. So yeah, there's so many ways to answer this. I'll try to limit the amount of examples I give, but um, I mean, so I've had clients who've taken the 0% credit and been able and use that funding to acquire an existing business, right? So instead of going out and getting an SBA loan or raising capital from family and friends or whatever, they'll go out, take that 0% money, buy a business that's already cash flowing. Like, I don't know, I had a guy who bought a laundromat, right? And um, yeah, there's all different types of examples of this, but e-commerce businesses, websites that are sort of already generating some kind of return, and they come in and sort of just fix up the business, cut some of the costs, improve the marketing or whatever, and start to generate return on investment pretty quickly. So there are people who are like professional business flippers and know how to acquire an existing business that's already cash flowing and use a 0% funding to do that.
That's a
Obviously,
great talent. That's a great talent.
yes, yeah, that is a super talent. That's something I would love to learn more about myself. Um, then there's kind of the traditional scaling your marketing campaign. That's one of the big uses, like in e-commerce, coaching, lead gen, these kinds of businesses. If you already have a process that's working, and it's just a matter of like, well, if I could spend twice as much on ads or four times as much on ads, I would, scale my profits that much more quickly. Well, you can use a 0% funding to do that, right? Within that promotional period, you could use a 0% funding to scale your Facebook ads, Google ads, influencer partnerships, whatever it might be, and get that return on investment from your marketing before the credit balance, that interest kicks in on the credit balances.
So the most innovative strategy that you saw used out there is the one you mentioned initially, the one that what was it? I kind of forgot. It was
The business acquisition.
no, way before that one. Uh, you said something. I don't know why I'm thinking about mattress. You bought something. You mentioned something like that. One of your clients had a very innovative way of flipping it. Um, it was the real estate.
Oh, the real estate example for the guy Alex I was talking about before.
Yes.
So that was the fix and flip sort of method. But we also have a lot of people in the real estate doing the BRRR, the BRRR strategy. Buy, what is it? It's buy, rehab, rent, refinance, right? There's something in
Uh-huh.
residential real estate that they do.
Uh-huh.
And so you can sort of use the stacked credit cards to pay for the rehab phase, using that 0% APR period to cover the renovation costs and out-of-pocket expenses while you're getting the property rented and refinanced and all of that stuff. So that's another very common strategy. I've had folks, like I said, in the uh, uh, speculative investment, sort of trading bots and Forex and all of that investments. Um, Plenty of folks who have used it to invest in digital assets, kind of similar idea to the business acquisition method, but maybe high ticket affiliate websites and e-com stores and sort of being able to buy those businesses kind of already or those websites and then just kind of improve and their acquisition and all of that and their marketing and
Leveraging
sort
the
of generate
traffic
more
from
passive
them, right?
income. Yeah. Worked with a lot of course creators and online coaches who've been able to use the 0% funding to sort of pay for the videography, for whatever marketing costs, to be able to create the course. Maybe they already had a course and that was successful. Now they're making part two or another sort of branching out into a different sector, and they're able to sort of use the 0% funding for that. Another big one, it sounds boring, but most businesses are selling some kind of product, right? Not necessarily a service. And um, so if you're in retail or in e-com or anything like that, where you have to buy actual physical product and then sell it to people and ship it to them or whatever, or sell it in your store, you can use the 0% funding to basically do something called inventory arbitrage, where you purchase these products in bulk at discounted prices, and then you resell them at a marked up price through platforms like Amazon, eBay, Shopify, whatever it might be. And you have that 12-month promotional period to be able to move this product while you're not paying interest on it. So that's also very powerful. But I mean, just one last example. Like I
Yeah, no,
said,
go ahead.
it can be there are so many different things it could be. I'm talking about sort of the ones that come to mind that we see the most
Mhm.
often. But like I had a guy who used the 0% funding to start a golf cart business.
How did you go?
You know what I mean? So it can literally be anything. I mean, a golf cart business, which is really cool, and he actually made pretty good money off of it as a side hustle. But that's what I'm telling you. I mean, this guy, if you have an idea or a model that's proven to work, all you need sometimes is just the capital. It takes money to make money, right? And you just get the capital infused and you combine it with your idea and you can literally scale anything.
That's the
So,
biggest thing. That's why I'm in this industry particularly, because you're able to see how people take their passion from A to B through that, assisting them in marketing assets, in strategies, in brand development. Because the reason why we're developing our brand is for us to be us. Like, you want to um, burst out who you internally are as business builds up, and funding it, being able to fund it. When I was doing sales in this industry, not teaming up in marketing and doing higher, but just like the lower end of the bargain, on the sales appointment setting and closing, I had this lady that she wanted to build a washing machine business, and she needed the capital to buy at least 5 machines. It was an amazing model, I would say, because if you have an area that is saturated by students, you have that going on. They're renting, which was her plan. She had 2 kids that were stepping in high school into the higher realms of that type of experience. She was setting them up for business. That was a business for their kids, and now that you mentioned the golf course and other situations there, that's the surprise element that I like the most. Do you have any other like that?
oh boy, I'd have to think about it. I mean, like again, like we see a lot more of the traditional stuff, folks in trading, in real estate, in oh, trucking, actually. A lot of folks in transport, um, who, a guy has his own trucking business, he needs a major thing for them is cash flow. So being able to sort of just have cash on hand in between jobs and sort of keeping maintenance, and being able to buy gas and all the stuff that they need to do for their trucking business. But also just in general to be able to, for example, finance a new truck. Because like if you have a small trucking business with, 1, 2 trucks, a couple drivers, adding that third truck could mean a 30% increase in your revenue, right? So that's that's a huge industry for us.
Being able to buy a truck right off the bank, more loan. Maybe you have flatbeds. You already have those CDLA drivers. You just
Hmm.
need that credit. Yep, I'm all about that. Last question
Hmm.
for you, Daniel. It's been great. Hey, public, thank you for being here. Uh, uh, Hopefully, what we have shared up to now makes the water a little bit clearer for you, and you step into that next phase of being able to fund your dream, your passion. You know that it works already. You just need to add a little bit more to that, like the truck example, or washing machines, or any type of um, assessed risk on that type of investment with Forex or cryptocurrency. So. Uh, we're already at 54 minutes. Let's make it less than an hour this time. I know that you're busy. Structuring business entities for optimal funding. I know that you're able to expedite the process with your relationship managers at the bank. You're able to get as best as possible scenarios for people listening. So make sure you fill up the form, that click the link uh, on this part of the entity optimum business structure side. What do you have for the public?
All right. Um, so when it comes to creating a business entity, so we work with a lot of folks who are maybe just getting started out. Mine don't even have an LLC, right? So uh, the first thing is setting up the business in a way that makes it as low risk profile as possible to the bank, and making them, want to lend you money because you're low risk and whatever, right? So you obviously have the two options of how you want to structure it, and that's kind of more up to the customer. Do you want to do an LLC? Do you want to do a C corp, S corp? Whatever kind of corporation. And there's different advantages to each, right? And there's different tax considerations, but this is kind of more on the customer's preference side of things. Then you obviously need to establish, the business entity by getting what's essentially a social security number for your business, which is called an EIN, employee identification number, which the IRS, uses to separate your personal and your business finances, right? Your personal stuff's on your personal social security number. Your business is on your EIN, right? Then you also need to, set up a business bank account once you have that LLC or corporation, to be able to, keep things separate. You want to keep your business life separate from your personal life. But when you set up that business account, you want to make sure that also the bank, the way you set it up, that the code that the bank uses is a low risk code. So instead of saying, yeah, I'm in, real estate investing, I would say I'm a real estate consultant, right? I wouldn't open any account or business. It's a matter of how you talk, how you explain it, right? It's a matter of how you describe it at the end of the day. And we just want to make sure we're
How you
describing, I
look at
wouldn't
your
say
business, right? The scheme that you have for your
exactly
business, how you sell it to
like
yourself.
exactly. Like I wouldn't say I'm a marketing agency, for example. I would say I'm a marketing consultant, right? Um, and that just lowers your risk profile significantly. So you just want to make sure, you set your business up right. And we have a whole process for that, and making sure that it's, a low risk profile. Like I said, the LLC versus corporation thing, that kind of is on the customer and what kind of business they're trying to run. If they have partners, their different tax considerations and all of that. And then, we can also focus on building business credit. Although at the end of the day, you have to have big millions in assets, and to be able to really take advantage of business credit with your DUNS number and your trade lines and all that stuff. All that stuff's great and certainly will help incrementally, but they're not going to let you borrow money. The banks aren't going to let you borrow money and not have a personal guarantee unless you have big assets that can back up. So business assets that you can use as collateral, and to not be able to have that personal guarantee, right? So those are kind of the things that come to mind when I get asked that question. Or at the end of the day, it's low risk is what you're trying to convey to the bank, right? And that comes into play when you create the business. And you can also edit it after an LLC is created. It doesn't mean it's a static thing. You can also go and change things, change the documentation somewhat to lower your risk profile. And then the other big thing is obviously then establishing that relationship with the bank and making sure that they also see you as a low risk entity, so that they'll be more likely to. We have a lot of customers go and open up a Chase account, for a Chase business account, for example, and to start to just put some money in that, use it a little bit, and that goes a long way in terms of getting you more funding, from Chase, for example. So you want to establish those relationships and make sure that they see you as somebody that they want to throw money at, essentially.
Now we are at the end of this. I want to stab this final note. There are, and I'm hearing a little bit of echo in the background. Hopefully it doesn't mess up anything. When you don't have an aged business, one of the things that we used to do was with the state of Colorado, the Secretary of State of Colorado, we would grab aged businesses, or shelf businesses. They're on the shelf for us to, grab and put your name on it, so that it's in well standing with the Secretary of State of Colorado. and then you're able to, under that aged business, with uh, the amount of outstanding it has, not only age, tap into 100, 150, 100, really good credits, that then, liquidation strategies come into play. You're able to move money from one side to the other, and it gets really good at that time. Usually we would get discounted packages, with the right relationships. You might be in the same situation where, people might want to invest in an aged corp. Is that a thing?
It is, yep, absolutely. And there's additional costs there, obviously, to buying an aged corporation. But there are big upsides, big benefits in terms of potential, credit card limits on a 1-year-old business versus a 10-year-old business is a very different thing, right? And um, so yeah, that is part of, something we can get into, and it's something that our funding coaches help a lot of folks get access to is an age corp. Um, but you also want to be careful with those because, you don't want to, I don't know, explode a business and then find out later on that, oh, there was somebody who was a partner in this business that I didn't even know existed. And, there have been some funny cases like that down the road where it's like, hey, this business all of a sudden is worth, millions of dollars. And people come out of the woodwork like, hey, I'm a partner in this business. I was one of the original owners, and, legal situations arise and whatever. So you just want to make sure it's clean. That's the thing. You want to make sure it's when you buy it, it's actually a clean aged corp. So again, you want to work with people who know what they're doing and are professionals and have done this before. When you get into that kind of stuff.
Exactly. All right. Hey, well, listeners, thank you so much for being here with us. It's been great. Daniel Noe, very insightful to have you in the program. Uh, Thank you for your time. I really value that. Whoever wants to jump in, he's a family guy. He knows how to fund businesses. He'll take you by the hand, give you the coaching and the relationships that you need to expedite the whole process and secure the funds for your business to grow. If you want to learn more, you're gonna see articles on recent changes in 0% business credit landscapes. You're gonna see how to maintain your business credit. You'll see as well multiple business cards whenever you're managing them, how to do it appropriately, warning signs, and just over leveraging them. You don't want to do that because you're going to raise alarms. You'll get more of that information with Daniel as well live. So fill up the form, click the link. Right, first click the link, fill up the form, and you'll be in contact with Daniel. Is it in articles? Whatever the avenue is, this is a live persona right here. I have him with us. Thank you.
Real person. Yep.
Real person.
And I
So
will
thank
say,
you. Thank you all for
sorry,
being
one
here.
last thing
Oh, go
is
ahead.
the last thing is just, yeah, we have testimonials on the website. We also have videos explaining what we do. www.autoscale-digital.com, autoscale-digital.com. You can also just email me, daniel@autoscale-digital.com. Happy to answer questions. But like Kyle said, there'll be a link somewhere. We have on our various social platforms all over our website. If you want to schedule a call, free consultation, happy to talk and see if it's something we can help you with.
Most certainly. All right, guys. Well, it's been a blast. I'll see you in the next episode.